Bitcoin has been stuck for months now, moving sideways, chopping around the same levels, and testing everyone's patience. 6 months of noise, 6 months of indecision, 6 months of nothing. But if you look closely, something subtle is happening beneath the surface. Momentum is slowing, market structure is tightening, and the indicators, the ones that actually measure the heartbeat of the market, are showing us that Bitcoin might be entering one of its rare equilibrium phases. So, in this video, we'll break down the data behind Bitcoin's fading pulse, from momentum decay to participation collapse, and uncover what this balance really means. Let's get into it. If you feel like the market's been playing tricks on you lately, you're definitely not alone. To the untrained eye, this just looks like random movement, frustrating, structureless, and hard to trade. But markets rarely stay random for long. They organize, they cohere, and when we look through the lens of deeper cycle metrics, we can see that structure beginning to form again, quietly, underneath all the chop. So let's walk through what's really happening here, indicator by indicator. First, let's start with momentum, because that's where every major market transition begins. Here we're using the SigmaQuant diminishing MACD, which adapts the classic MACD logic to Bitcoin's logarithmic price scale and cyclical nature. In every prior cycle, 2013, 2017, 2021, this indicator trended higher and higher until it reached a clear parabolic top, signaling the peak of bullish energy. But this cycle is different. The diminishing MACD has been making lower highs, even as price has climbed. That's a classic case of momentum divergence. It tells us the underlying energy of the market is fading rather than building. Now, that doesn't mean Bitcoin is about to collapse, but it does mean the engine that drives explosive rallies is losing steam. It's the first clue that we're in a slower, more mature phase of the cycle, one defined by balance rather than euphoria. The next indicator that confirms this pattern is the special SigmaQuant meaningful volume metric, a sophisticated way to measure whether volume is coming in above or below expectations. Instead of just counting raw bars, it normalizes for volatility and filters for meaningful moves, showing whether real conviction is entering the market. And right now, just like the diminishing MACD, meaningful volume is showing loss of energy. Each rally this cycle, the ones that pushed Bitcoin to new all-time highs, has done so with meaningful volume support. However, when no meaningful volume is injected for a long period of time, this can signal a momentum breakdown, despite the discovery of new all-time highs. That exact pattern was the precursor to the 2021 momentum breakdown, when the second all-time high failed to attract real participation. We're seeing that again now, and it reinforces the story. Enthusiasm is fading, participation is thinning, and the market is slowly exhausting itself. So where's the line that separates slow bleed from outright breakdown? For that, we use the 30-day versus 365-day moving average cloud, a simple but powerful regime filter. When the 30-day average is above the 365-day, the cloud is green, meaning bullish momentum still dominates. When it drops below, the cloud flips red, marking a bearish regime. Right now, the cloud remains green. The uptrend technically holds, but the threshold sits right around $100,000. That's the critical support level. If Bitcoin breaks below that, it's not just a dip, it's a potential regime shift. That's where I'd personally start to reconsider the bullish bias altogether. Now let's zoom out with an on-chain perspective using the MVRV 2-year delta. This metric measures the spread between Bitcoin's market value and its realized value, averaged over a 2-year window. In past cycles, this spread expanded dramatically during euphoric phases, the classic overheated market signature. But this time, it's tightening. That compression tells us Bitcoin is maturing, price discovery is smoother, volatility is compressing, and speculative excesses are being absorbed more efficiently. It's not the behavior of an immature bubble. It's the behavior of a stabilizing asset class. That might frustrate traders looking for wild swings, but it's actually a powerful sign of structural health. Next, let's turn to the Z-score price probability waves. one of my favorite tools for framing price extremes statistically. This indicator translates Bitcoin's deviations into standard deviation units, mapping how overbought or oversold the market really is. Z-score gives us a reality check and estimates the statistical probability of the next price move. Most tops happened at +2 or +3 sigma level, while most bottoms occurred at -2 or -3 sigma. And right now, we're sitting almost exactly at 0 sigma. That's the definition of equilibrium. Neither stretch to the upside nor to the downside. Historically, these neutral zones precede large directional moves. It's the market's way of taking a breath before the next impulse. This gives us two key levels to watch. A move towards +2 sigma, which is $122,000, would mean a potential bullish trend continuation with a possibility of further price discovery, whilst a dip below -2 sigma at $104,000 would signal market weakness and a structural breakdown leading to a deeper correction. So while everyone sees nothing happening, the Z-score tells us tension is building, and volatility compression like this rarely lasts forever. Finally, let's talk about volatility through the lens of ATH Drawdown, the distance from Bitcoin's all-time high. Historically, after every parabolic run, Bitcoin has suffered brutal drawdowns, 70%, 80%, sometimes more. But this cycle's drawdowns have been far shallower. That's not random, that's evolution. It's a reflection of Bitcoin's growing maturity, deeper liquidity, and integration into macro financial systems. It also supports the idea that this cycle's top, whenever it comes, might not end in a dramatic blow-off, but in a slow, grinding fade. And while that might sound boring, it's also healthier. Less chaos, less risk, more structure. That's what long-term adoption looks like. So let's bring it all together. The diminishing MACD shows fading energy. The volume surge shows weakening participation. The 30/365 cloud defines a crucial $97,000 line in the sand. The MVRV 2-year delta shows maturing compression. The Z-score probability shows statistical balance, and the ATH drawdown confirms the macro stabilization trend. Put simply, Bitcoin is in equilibrium. This isn't euphoria and it isn't panic, it's balance. The kind of fragile balance that often sets the stage for explosive change. So, what's next? For now, patience is the strategy. If Bitcoin reclaims $120,000 and holds it as support, we could see momentum reignite, targeting the next wave higher. But if we lose $100,000, that's the regime shift. That's where the slow bleed could accelerate. Either way, this is the point where watching the structure matters more than watching the price. Because when markets enter equilibrium, tension builds. And when that tension finally breaks, the next move is rarely small. We are SigmaQuant. Subscribe to think smarter, trade sharper, and see beyond the charts. Thanks for watching, and see you in the next one.